Welcome to GoToWebinar, Webinars Made Easy.
Good morning, everybody. Can you hear me now? I believe we may have had an audio issue. If you can hear me, could you click please on the raise your hand button that I have just clicked on there. If you could click on the raise your hand. I'm just clicking on raise your hand. If you could click on that, please. Okay, good. Apologies for that. I think we had some audio issues before. Just make sure it's okay. We'll just get this right before I hand over. Cannot hear. Okay, great. All right, brilliant. I think we're good to go. All right, sorry about that. So this is an interactive session today. If you have any questions, please feel free to drop them into this little panel here. So if you have any issues at all, if your question is pertinent to what we're talking about at the time, I'll drop it in and hand over to the experts and they will answer. Otherwise, we'll save it until the Q&A section at the end. So if you have any questions or any feedback, please drop them in here. Okay, without further ado, I think I'll hand over to our speakers today. Mike, over to you.
Good morning, everyone. I'm going to just introduce myself, but before I do, I'll just give you a layout of how the presentation will go. It'll be, initially it'll be my introductions of the team here, which is going to be myself, Scott and Huang Hang, who are going to talk to you this morning, trying to make this a little bit more interesting, which is a relatively dry subject. We'll then go in and explain a lot about the treaty and its application and some of the current discussions about where it will benefit UK companies. So that will be how we'll take this forward. But probably just start with, I'll just explain. I'm a director with PwC. I'm part of the China Business Group. I've been working with Chinese clients both inbound and outbound now for a number of years. I'm seeing a large increase now of Chinese business coming into the UK, whereas before it's always been about us looking to China. So we're seeing a big change in the way that we're now dealing with China. Hence why I'm based in the UK and I'm supported by my colleagues, and I'll allow Scott to introduce himself.
Yes, good morning everyone. I'm Scott Lindsey. I'm actually a UK partner, but I'm based in Hong Kong. I've been doing international tax for probably the last 15 years and moved to Hong Kong about 18 months ago to try and help service the both inbound into Hong Kong and Chinese coming outbound as well, to try and help everyone navigate the intricacies that is or are international tax.
Thanks, Scott. And I'll just allow my colleague who is on secondment to me. She's known as Gabi in the UK, is her English name. Just introduce yourself, Gabi.
Good morning, everyone. I'm Gabi, came from China. I have worked in PwC China for several years and now on secondment to the London office, assisting the UK companies and international entrepreneurs to expand into the China market and look for any business opportunities, and also vice versa. I'm quite familiar with the China tax and business regulations and have lots of experience dealing with the Chinese issues, so feel free to ask questions about China.
Right. Moving forward, as I said, this is can get very complicated session. We're going to try and keep it at a key level, just showing some of the experience that Scott and I have of working with clients going into China. Feel free, if there are any questions, butt in. We will then try and answer them as we go through, because it will make it life easier for us. But I'm going to start off with what's the objective of the session. And the objective here is basically there is a new China-UK double taxation treaty, and we're just going to look at what that opportunity is arising from that. But before we do so, I just want to explain, why are we talking about that? What's the benefit of a treaty here? So for those who are in the tax field, they'll all know that this tax treaty defines what the taxes where there is an opportunity of double taxation arising. It will say who's going to be taxed and who has the taxing rights. It will lay out withholding taxes and limitation of tax. And it defines procedural framework and enforcement and dispute resolutions around that treaty. So what we're going to try and do is trying to actually raise where China now is getting into developing new treaties and actually then explain a little about some of the concepts within that treaty itself. So without much ado, we're moving on to part 2, the background of the new treaty. And as I said, we're going to take it in turns here, so feel free to ask any questions we go through. Starting off now, what was there before? Well, there was no reason really for treaties in the past with China, because there were no withholding taxes, for example, on dividends, so they weren't that worried of a number of things. So the existing treaty became effective. It was about January 1985. It was one of what we called a new generation of treaties. It's when China started entering into treaties with the outside world and started defining some of its relationships with them. There became a need for them to recognize that treaty was becoming more important, and there's then been a move by China to actually develop new treaty arrangements, and it's not only with Singapore and Hong Kong, but a number of other operations. And you've got an organization in China called State Administration of Taxation, who wanted to create a level playing field in which the treaty jurisdictions are working. And they've been actually trying now to standardize the treaties which are now being entered into by China and the rest of the world. So therefore, as a result, there's been, over a period of time, China's been built up this new treaty, which is supposedly to come in effect from the 1st of January 2014. It's going to be, as I've said, a new standardized type of treaty, follows the OECD to a large extent, which means that it's going to have some standardized arrangements, except that then China does have its own way of interpreting the treaty. So the new treaty, effective really from 2014, and is going to be sort of lay out a number of the different terms and the relationships which will then govern how tax between the UK and China is going to work. So I'm going to start off with the first, just laying out what's in the treaty, some key points, and then Scott will actually, Scott's going to lay out some of the key points here, and
Sorry, I think we're going to take it in turns, aren't you? So I'm going to take this first page here, which we're just going to pick up on a couple of key points. The one thing that I want to focus on here is the service PE issue. And what previously I've had clients had quite a few issues with were when they invoice into China for services provided in the UK. And this goes down to sort of the Chinese tax authorities' interpretation and understanding of how services get provided internationally. What would happen is a UK company would provide some consulting. It might be doing a piece of technical analysis or providing some tax return services for expats who are in China, and they would then invoice the Chinese company. The payment that would be made on that invoice had to get approval from the authorities. The authorities wouldn't give approval without withholding some tax. Now, their rationale was, well, if you've provided a service to a Chinese company, you must have been in China providing that service. Now, we all know that that's not necessarily the case, but they decided that what they would do was, and generally this was the numbers that would be applied, would say, well, about 40% of what you're trying to charge has probably happened in China, so we'll treat that as taxable, and then we'll slap on, well, we'll apply the 25% corporate tax rate to that, which gives you 10%, which looked a bit like a withholding tax, and quite a few of my clients certainly just left it as a withholding tax until you dig down a bit deeper and find out what's really happening. And this, so hopefully the benefit of the change here in this service PE part is that on the right-hand side you'll see that there's now a provision within the treaty. So theoretically, this should tell the Chinese tax authorities that you can't have a permanent establishment. In other words, you can't have a place of a taxable presence in China unless you've been there for 183 days within a 12-month period. Now, it will, I think this goes more generally to comments on the sort of the Chinese tax authorities. This will take a while for this to filter down from the treaty becoming applicable down to the sort of the local level tax inspectors. but it gives us a good legal framework to start arguing that this was effectively a withholding tax should no longer be levied. That's the main point, I think, from that slide.
Okay, moving on then to the next slide. Looking at the standard provisions for passive income, the treaty has changed, probably most noticeably, the dividend rate, which has now dropped from a 10% standard rate as we currently apply for dividends paid to the UK to a 5%. But it actually has a slight change in there, because it says now with a minimum direct shareholding or indirect shareholding. And that's one of the few changes in the treaty which is not common to all of the standard treaties. There's only one other Chinese treaty they've entered into, which is Trinidad and Tobago, which is the same definition of direct and indirect. And so on that point, it's going to be interesting because there's no definition, and SAT, which is the State Administration of Taxation, will be looked at to actually give a better definition on that. Interest rates remain unchanged, so there's no difference on the treaty. Royalties generally unchanged. There's a slight drop from 7 to 6% for equipment stroke leasing rental. But what is the interesting things is this, the move within the treaty for what's called the limitation of benefit. And for those who, just to give a slight understanding, a limitation of benefit is a clause which is now built into treaties, which stops people taking a benefit of a treaty if you were doing it for just tax reasons. So there has to be a good reason why you're actually taking the benefit of the treaty. So they would look for a number of different tests to actually decide whether you are enabled to take a benefit onto the treaty itself. So looking at this is then the first of the anti-avoidance provisions that the Chinese are now starting to build into the treaty. And that limitation of benefit applies to all of the passive income clauses. So, and we will be talking about this a little bit more later, but it is important to recognize that this now is a provision which has not been existed before, but now is moving into the way the Chinese are interpreting their treaties. I'll move on to the next slide.
Okay, so I'm going to take this one. The change that's happened here in regards capital gains probably requires me just to explain a little bit about how a particular aspect of the Chinese tax system, which you may or may not be aware of, but quite often if you're not aware of it, it can catch people by surprise. If a UK company holds shares in a Chinese company and it sells those shares either within the group or to a third party, China will try and tax any gain on those shares at 10%. It commonly referred to as a non-resident capital gains tax, i.e. you're taxing, China applies a tax to someone who isn't within China. And we'll see in examples when we talk about it later, but it's a very important driver in how you decide to hold your investment in China. And so what's happened here in the treaty, the change, which is generally beneficial, is that if you own 25%, or sorry, less than 25% interest in a Chinese company, you will actually be exempt from that tax. So that's a good thing. On the other hand, if you own more than 25%, so you've got 100% subsidiary, you will not be exempt from that tax. But that is consistent with the position in the old treaty. The point there about property-rich shares is that in order to be, if you have a company which owns a lot of land or property, then you will automatically be taxed, no matter what the existence of the treaty, if the value of your company is made up of more than 50% land. So that's capital gains. As I said, we'll come on to that later. The other bit down here to talk about is the general anti-avoidance rule. Again, we'll see how that applies, but China has a general anti-avoidance rule. So if you do anything that the tax authorities think is is deliberately trying to avoid tax, they will try and tax you on that. Generally, double tax treaties will override domestic legislation. So if you were in a situation where you had protection from tax from the double tax treaty, you would rely on that to trump the local tax rules, if you like. However, what this tax treaty does is it allows China to use its domestic general anti-avoidance rules to trump the treaty. And that's an interesting development generally in international tax, if there is such a thing. But it's quite important here because you can't, if you're seen to be avoiding tax, and that's Chinese tax authority interpretation of that, then you can't rely on the tax treaty for protection.
Thank you. Thanks, Scott. The only other treaty I'd say where arrangements like that are going to be like the US have a similar sort of approach. So it's interesting to see how the Chinese are going to use interpretation going forward. I suppose what we're looking now at is before we start applying some of these treaty provisions, is what's of interest to UK investors. Well, there are benefits and there are challenges, and there's also going to be what the future brings. So what are the benefits? Well, we've talked about the dividend reduction, which in itself brings us onto a level par with Singapore and Hong Kong. You've got the 25% notification now on the capital gain, which makes it easier. You've got a better interpretation of PEs, because as I believe in earlier treaties, it was always been there were a number of questions over how that interpretation of the PE would work. Challenges. Well, the biggest challenge is the anti-avoidance, and I suppose you have to put this in perspective. China is one of the few countries around the world which is a world tax. It taxes worldwide. It's moving towards a procedure, understanding procedures and understanding anti-avoidance. So it's not surprising that you're starting to see introduction of GAR. We're seeing it in the UK, and it's everywhere at the moment in a number of different jurisdictions. So the whole approach by the SAT to this is consistent with every other jurisdiction. What it does show is that, and correct me if I'm wrong because Scott's more close, is that the Chinese will start looking for substance over form in some of their application of the general avoidance. But you're going to find is they're going to actually apply more interpretation to that. I don't know if you've got any comments, Scott, before we move on.
I mean, I just think that the fact that China is pushing to introduce this GAR article, it's in the UK treaty, they're pushing to have it in other treaties, is just a growing part of the growing confidence that they have in terms of where they sit internationally within tax and how they want to get what they perceive as their fair share of tax. I think they understand that their tax system is developing, and it's got a long way to go before everyone's comfortable with how it operates. But they're not. That doesn't mean that they're scared to apply it how they want to apply it. So, in a global context, I think that's it's something that we need to be aware of and watch out for.
So I think, if without much ado, we'll move on now to sort of the investment into China using either Hong Kong or the UK. How do we apply the treaty in some respects here? And this is just going to actually give a view of what some of the issues will be. So I'm dealing with clients regularly, and so a number of the questions clients are always asking when I'm going into China: how should I structure into China? Do I use an intermediary vehicle to do so, or do I go direct? How do I actually work out the cost of that? How do I know, is it complicated to get money out, extraction of profits? And are there any other issues I need to take into account? They're the standard questions which have been there, and they apply to not only China but any other jurisdiction. Except there is this closer alliance now where we've been used to dealing with Hong Kong, or for that Singapore, as an intermediary vehicle for investing into China. Now the question is, can we go direct? So I'll now move on to the next slide. Is now, what are the considerations when moving into different jurisdictions? I'll allow Scott to move into this bit.
Okay, so I mean, just to recap, and I'm sure most of you are aware of this and have thought about it, but really there's two things that you wanna try and nail down when you're thinking about making an investment into China. Let's assume that you set up your company and everything goes well and you start making profits in China. At some point, you're going to want to try and get those profits back to the holding company in the diagram here, and more often than not, that's going to be in the form of a dividend. So you're going to want to make sure that you lose as little tax as possible on the repatriation of those profits. So that's the first thing. The second thing is, most commonly what happens is either there's a disposal, perhaps to a third party, of that investment in China, or it might just be that you decide to reorganize your group because you want to restructure for various reasons. And as we touched upon already, the movement, the sale, the transfer of those shares in the Chinese company will be subject to Chinese tax to the extent that there is a gain in there. So that's the second thing. And I think those two things, more than anything, drive how you decide that you want to structure your investment into China. So what's going on in the double tax treaty now that is going to influence the decision that you make when considering these two things? So first up is the dividend. Previously, I think we've already said, it was almost a default position that you would, if you were in the UK, you would use Hong Kong as an intermediate investment company into China. And that's because it had 5% withholding tax on dividends. As Mike said, Singapore also had it, but Hong Kong was just generally easier, unless you happen to be in Singapore already. That's gone. So what we're now in a situation is under that yellow line there, we see Hong Kong and UK under the new treaty. They're exactly the same. So that's leveled the playing field. What it really means is that effectively dividend withholding tax, subject to actually getting the benefit of the treaty, which Mike's going to come on to in a second, but dividend withholding tax on the face of it is actually no longer part of the decision-making process. And so on one hand that's good, but as Mike's going to explain, to get the benefit of the treaty, you need to have certain factors present within your group.
Thank you. Moving on then to the next slide. Now, we were talking about understanding treaties. So a lot of treaties follow a standard concept of using limitation of benefit, and actually the application of when you will get benefits under the treaty itself. One of the normal areas of limiting benefit is actually understanding who is the beneficial owner requirement. Now, the Chinese have brought in 2009 what is called Circular 1, which is Circular 601, the first one of that period, and it basically defines how the Chinese are looking at the beneficial owner requirement. Now, the beneficial owner is when who owns the passive income, who owns the shares, and will you be able to actually receive the benefit of a reduced withholding, the capital gain, and will you be able to take that advantage and take that reduction? Now, the Chinese have got not only just defined the beneficial ownership, which it's on the screen, but they've also given a number of factors where they see it as where it won't apply. And these are not fully defined, but they're actually being then sort of extended in the subsequent circular called 165. And the aim here is, as they were looking at unfavourable factors where they will say the treaty won't apply. So you won't be able to take your reduction in dividend or the capital gains. So they're going to look here at issues of, is the structure a shell structure, a conduit structure, an agency? So merely just sticking a company in Hong Kong as a conduit route to take the benefit, and or in the UK, just to take advantage of the treaty will not be an easy route anymore. So they're going to look at a number of factors then to actually try and limit that application. So moving on to the next slide, here then is what would happen if the Hong Kong shell, if Hong Kong company is a shell company, then the issue here is that you'll be caught without business activities. Hong Kong claims tax treaty benefit of 5% withholding on tax income. But the Chinese are now going to say, well, if with beneficial ownership and application of that, their aim will be to try and deny that relief. And I'll turn to Scott to actually see if he's got any views on that, how that may be applied, or has he seen anything yet in practice?
Well, I mean, generally, you have to go and get a clearance to be able to pay the dividend gross of the withholding tax. And so what you see certainly with Chinese companies looking to pay a dividend to Hong Kong is that they'll ask you for the substance. So they want to see the accounts, they want to see the number of people that you've got in there, they want to know the activity that's going on. And the tricky bit about this is that you get clearance at a local level. So there is no standard uniform interpretation of exactly what Circular 601 is. So this Circular 165 attempts to try and actually lessen the grip, if you like, of the local bureaus in denying treaty benefits. But as ever with sort of Chinese tax, the actual decision is very much at the local level, and because it varies so much around the country, it's really difficult to get any uniformity or certainty around your position and whether you are indeed going to qualify.
Thank you. And so the main aim here is that there is going to be a big push to review the substance of transactions here, not just to rely on that you've got a company in place and then think you can make the application for the treaty benefit itself. Moving on to Scott, then on indirect transfer.
Okay, so this, you may or may not have heard of Circular 698. Where you may well have heard of it is in an Indian context. This concept, there was a Vodafone case where the Indian tax authorities tried to tax Vodafone for what is called an indirect transfer. So in this example up here on the slide, alternative is company A owns company B directly, or it inserts an intermediate holding company. And the reason you insert that company is that you know that if you were to sell the shares in B directly, you would suffer Chinese withholding tax on any gain. If you transfer the shares in the intermediate holding company, that should be in a jurisdiction which doesn't apply a non-resident capital gains tax and meets various other criteria which would result in no taxation. And so in the bit on the right-hand side of the screen, you've got a transfer going on, and hopefully you think you've achieved the transfer without suffering any Chinese tax. The Chinese authority, this was done for quite a while, until maybe about, I think it's 3 years ago now, the Chinese introduced Circular 698. What this is, not to go into too much detail, it's a reporting requirement. You have to tell the Chinese tax authorities if you indirectly transfer shares in a Chinese company, and that is done via this IHC here, and it either has a tax rate of less than 12.5%, or it doesn't tax capital gains on the transfer of shares. Now, the purpose of this is to allow the Chinese tax authorities to gather information and to know whether they then want to apply the GAR, the General Anti-Avoidance Rule, which we talked about earlier. And so if they deem that there is not sufficient substance in this IHC, i.e. it is a mere shell company, then they can use the anti-avoidance rule to disregard the IHC and would therefore deem there to be a direct transfer of shares in the Chinese subsidiary. And then, to the extent that you've got any capital gain, they're going to tax you at 10%. So this is a big deal for a lot of groups. On the next slide, we've just got some detail as to the reporting requirements that you have to do. I'm not proposing to go into detail on those, except just to tell you that it's a pretty onerous provision, and so quite often it's best to ensure that you don't fall within the reporting requirements themselves. So that's, I mean, that is as I said, that's a big deal for a lot of groups, and depending on how much substance you can put into that intermediate holding company or not will determine either your exposure to potential Chinese tax or your obligations under this reporting requirement. And then I think what we're going to do now is just talk through some examples of using UK direct or via Hong Kong, and talk about how the two areas that we're concerned with, dividends and non-resident capital gain tax, how they might impact your decision.
Thank you, Nick. So looking at the UK, so now we've got the new treaties in place. We're now assuming the treaties here. Can we go direct? So the issue there is, yes, you can, and it's from an administrative cost and from a management position, it's going to be a lot more cheaper if you do go direct. You'll be able to monitor and be able to get the same benefit as if you had used Hong Kong into intermediary. You've now got the 5% withholding tax. So we're assuming here now the UK has met all the limitation of benefits, has got beneficial ownership rules, has not fell foul of any substance. So now you've got the dividend repatriation is at 5%. You're no different than Hong Kong. And we also then get the, then we have the equity transfer, which, as Scott mentioned before, is it's got a 25% stake arrangement, but you're no worse off than where you were before, and it is still, there are still relative advantages. So that's the only, I would call, I put my non-smiley face there, is not a perfect answer. So from a UK perspective, on the general trading company entering into China, UK direct is not a bad position to go. Scott now will actually just explain where it moves on to now into why where Hong Kong fits in.
So, I mean, if you don't have any presence in Hong Kong already, as Mike's just said, you know, and you set up a Hong Kong company as intermediate holding company, you know, it's a bit more hassle. You've got the administrative and running costs, and so, you know, do you really want to do that? We'll come on to why you might want to. But an actual downside tax risk here is that if you don't have sufficient substance, then, as we talked about, the Chinese authorities may well deny you the 5% withholding on dividends. And interestingly, what they don't necessarily do is to say, okay, well, if I ignore the Hong Kong company, I'll then look at who am I really paying the dividend to? Is it to the UK? And then would I get 5% anyway? They don't actually always do that. What they just say is, well, no, you're trying to apply the Hong Kong-China double tax treaty, but it doesn't apply because you're not the beneficial owner. Therefore, we're just going to slap 10% on you. So what you actually do is you increase the potential tax cost. So that's something that you really need to consider when thinking about putting in a Hong Kong company that might not have the substance required. On the other hand, the smiley face down the bottom, you may be able to have sufficient substance in the Hong Kong company that if you want to transfer China, you actually transfer the shares in Hong Kong. And I think this is an interesting point, because the Chinese authorities are shifting, I think, to a more generous interpretation of the substance required. I think if you spoke to someone about 2 years ago, they would be telling you you need 5 people, you need to have a substantial business, you know, it's something that's trading, not just someone selling ice creams on a street corner. You know, we want to see real income and expense, people on the ground. That is shifting now, and the interesting bit is where it's going to end up. I'm not sure. There is some recognition that internationally it is common to have a holding company. And actually, it doesn't need to be doing that much to be just a pure investment company. You know, they exist all over the world. So, quite what's going to happen, I guess, as with many things in China, it's all moving, and so we won't know. But what you do for the smiley faces, you give yourself a chance of trying to mitigate that potential capital gains tax on the transfer of the China company.
Thank you. I suppose we're just now going to actually just between the two of us, just talk through what will now happen. You know, so I think it's given me a greater opportunity to actually see that can we have a direct ownership into the PRC. There are many reasons why that will be much more beneficial for a number of my clients, which I would say are more the middle market, from a purely cost and administration perspective. And purely because it's actually, they don't want the cost of running an operation either in Singapore or Hong Kong, which is not cheap to do. So it's not necessarily always tax driven. So from my perspective, I would expect that there will be more direct investment into China as a result of this, even though there is a downside on the capital gains. The other side is the UK is becoming a lot more favourable as a holding company regime in its own right. What will be interesting is that whether that, with the benefit of the treaty, as not all the other treaties have been ratified or standardised, is whether the UK as a entry vehicle into China may in its own turn start to happen, and that will be interesting to watch and see. So my perspective is, it will be on the table as a direct investment.
I think that's right, because there's a slight perception thing here as well from the Chinese tax authorities. So they kind of know that if Hong Kong is holding the shares in China, there's a good chance that it's there specifically to avoid this non-resident capital gains tax. That's just because it's what everyone has done. But if you use the UK to directly invest into China, there isn't that assumption. So, and I'm not saying that you can guarantee this, but there's much more likely to be just an acceptance that that's how the investment's been made, and that there's probably no tax avoidance going on. And so, would you be better trying to rely on that? You might have some substance in that UK company. It depends. So I agree with you, Mike. Using UK instead of Hong Kong might have some advantages.
And I suppose there is, and I'll turn to some of the questions in a second. There is the other issue you've raised is the anti-avoidance. Are we now going to, by directly are we exposing ourselves to some more of the anti-avoidance issues which are going on in China? The whole approach to hitting on this. My perspective is, I think that I hosted a Tianjin delegation from the tax authorities, SAT, a couple of months ago, and which were here specifically to assess our anti-avoidance. They've been travelling around. They are moving quickly into trying to understand how to bring anti-avoidance in. They're using the treaty to some extent to manage this, and they're going to interpret the treaty and how it applies probably a lot more differently. They do take unilateral decisions. The circulars are examples of that, where they will interpret the treaty rather than rely upon standard OECD interpretation. So whatever happens, whether you use Hong Kong or the UK, that will apply equally to both. I know we've had a question on capital gains. I'll probably allow you, Scott, to do that one.
So the question is basically, on the non-resident capital gains tax. So it's.
Let me just read out the question, because not everyone will have seen it. So this is a question from Jack. It says, for capital gains tax of an offshore equity transfer, would the sale side or the buy side, like the selling side and buying side, generally pick up the 10% tax? As the transaction happens offshore, how do the Chinese tax authorities collect that tax?
Okay, so the first question, who's it a tax on? It's a tax on the seller. So if I've made a profit of 100, I need to give 10% to the Chinese tax authorities. And great question, how do they collect it? So if I'm sat in the UK and on the right-hand side of the slide that we've got here, I sell PRC, and I receive that money offshore from a non-Chinese purchaser, what can the Chinese authorities do? Actually, nothing is technically the answer. But as with all these things, you've got to think through what the consequences are. What practically happens now is that the purchaser will want to see indelible proof that the 10% is not due. And unless you can produce that, they will. I've seen transactions where it's been put in escrow, or seen transactions where the seller has forced the purchaser has forced the seller to make the disclosure to the Chinese authorities to try and get them to agree either that the tax is due or not due. So summarize that by saying, they can't do anything, but in the long run, it's probably more sensible to make sure that you've covered the situation off.
And you also have the standardised approach to the treaties they've got more information gathering opportunities which they can get from the different authorities. to actually collect information and ask the UK to provide information on these transactions. However, this is no different to any other territory where tax has to be collected outside of a country. China's no different. It's just the question is how will they actually be able to move and enforce this? And as Scott has mentioned, that's only going to come around, and if that's part of the due diligence, the purchaser won't follow through with the deal unless he's got proof of tax being paid. So I haven't seen that. There's no other question apart from that one at the moment.
Not at the minute.
Yeah. So I think as you've seen, is that the treaty, it's new. It's going to be of benefit. It's going to be interesting how interpretation will play through in the coming years. It's all part of a standardized approach of China modernizing and not wanting to be seen anymore as an emerging economy. So you're going to see its application to these sorts of transactions a lot more. You've also got to recognize that investment into FDI into China is not only just coming from the developed world, as we call it, but the Chinese invest through, as we were talking before, to invest through countries such as Hong Kong, BVI, Singapore as well, and a circular route. So this will apply equally to them as it will apply to companies here in the UK. One other area we said we'd cover off and how this impacts on the decision we make is financing in China. So Gabi has been slightly quiet here. She's been preparing to actually just talk a little bit through this. So I'm going to let Gabi now take over.
Okay. Before going into the details of the funding requirement, I would like to clarify two concepts. One is the registered capital. It's the amount that the investment actually pay out by the investor by cash plus IPOLs. And the other one is the total investment. It's the amount of funds that the company required to establish and operate in China, including the registered capital and the debt. So the difference between the total investment and the registered capital is the maximum of the foreign loans. Let me take an example to make it clear. Assume that you invest $3 million US in China, so 2.1 million should be injected as registered capital within 2 years, and the remaining part of 900K can be the foreign loan that you can borrow from the foreign companies or financial institutions. So that's the funding requirement. Depends on different investment amount. That would be different ratio of the minimum registered capital. So about the capital requirement, when you want to increase the capital in future, that would be more welcome by the Chinese government as more investment, more welcome. But if you want to reduce the capital, it's rarely seen in the practical cases that the Chinese government would be reluctant to let you get the money out from China. So that's the difference between the China and the UK, because it's easier to reduce the capital in the UK.
Correct.
Next. Go to the next slides. Yeah. And about the foreign loan requirement, you may know that there is strict control of the foreign currency control in China. The in-charge bureau is the State Administration of Foreign Exchange. When you borrow foreign loans from abroad, you need to submit the relevant documents, including the foreign loan agreements with the SAFE, which need to be approved and assessed by them. When you pay back the interest and the principal capital of the loan, it also needs to be approved by the SAFE, and you need to submit the repayment schedule beforehand.
Right. So we have had a question, which is probably will be.
Here, a quick question from Robert. I invoice my WOFI from my Nevis and St. Kitts registered company for international services provided. Is withholding tax or any other tax due on this?
Shall I have a go?
Yeah, do you want to start and I'll join in?
I think for international services, that's kind of a bit of a catch-all. I think I would go back to my first example when we were looking at what's different in the new treaty from the old treaty. If if for some reason that the local authority thinks that some of these services may have been provided in China, then it may decide that you've got a permanent establishment, and therefore some of those in inverted commas profits could be subject to China tax. That clearly isn't a withholding tax, but it has the effect of it. And to follow sort of through on that, one point in the treaty with the UK, which now exists, is that there's an other income article, and that could well cover something like international services. And what that says is basically, if there's some income coming from China to the UK which is not covered specifically within the treaty, then it is actually only taxable in the UK. And so if the Chinese try to apply a tax, whether it's withholding tax or corporate tax, on that income, they wouldn't really be allowed to under the double tax treaty. And so to sort of apply this to the question here, which is the payment to St. Kitts and Nevis, there is no protection under the double tax treaty, and so if they decided they wanted to tax it, you wouldn't be able to get any protection. But I think I'm assuming that international services doesn't include sort of interest or royalties. I think the technical answer is no, there shouldn't be any withholding tax, but that will depend on the local tax bureau's interpretation of what an international service is.
I would probably add a couple of points to it. First of all, St. Kitts and Nevis doesn't have a treaty with China, so there is no protection, full stop. St. Kitts and Nevis is probably regarded as, it's a protector of the UK, is not protected under the UK treaty. So what you've got here is someone invoicing, and it sounds like an invoicing arrangement which is in place. Your issue is what would the domestic law apply first? And the first problem you've got is, will you be able to get a deduction in China for the invoice in the first place? Is there any substance and any services being rendered, or would this be seen as a management charge? When you're going through for payments through SAFE, you've got to know, will they allow the money to be remitted, or will it be deemed to be in the nature of a dividend? In which case you have to actually look at it in very different set of terms. So the Chinese, there are tolerance levels of where very small amounts may get through, but they look very closely at things, what services have been rendered, what sort of products have been sold, and is the invoice substantive enough to show that this was a proper transaction. They then, if you were going to have anything such as, and this is, let's say you're St. Kitts and Nevis where they own the company, they will then look at beneficial ownership and all of the terms which we've been on before about whether withholding taxes on dividends and everything apply. So the issue here is, there is no treaty, so normal domestic law will apply in China to any payments being made to it.
And business tax will also be imposed if either the provider or the recipient are based in China.
Correct.
Back to you, I think, then, Gabi. Yeah, so we cut you off midstream there, but I think we can get you back going again.
Yeah. Is that a question about the...
Oh, we have another one here from Jack. Yes, on foreign loan agreement, if the loan is between an offshore parent company and a foreign bank for a China transaction, does the loan agreement still need a safe registration?
Yes, all the foreign loans need a safe registration, but early this year, the SAFE has released some rules to release the control of the registration of the foreign debt. But the local banks still need to verify a lot of documents.
Correct. Yeah. Yes. And that procedure is still
the
onerous.
same,
yeah, it's still there. It's not changed.
Yeah. Okay, I think that's it for now. Back to you, Gabi.
Yeah.
You were just on this slide.
Yeah. Move on. Yeah.
Next slide.
Talking about whether it's better to borrow from local or from the foreign, it really depends, because if you borrow the foreign loans, you need to register with the SAFE, and the usage of the foreign loan is subject to the SAFE's approval, and is even that some certain restricted fields will be imposed that it's not allowed to use the foreign loans too. And if you borrow local loans, you really need to agree with the local banks what what's the purpose of the usage of the loan. Normally, it's only allowed for the working capital purpose.
Thank you.
The thin capitalization is quite common, which means that if the debt and equity ratio exceeds the ratio, the relevant interest expense will not be allowed to deduct from the expense in the company. So the ratio in China is debt equity ratio would be twice.
Thank you.
And the last point, we will talk about the tax issues about the foreign loans. Normally, when you pay back the interest expense, business tax will be imposed with 5% tax rate. There is no exemption or reduction rate because the tax treaty won't stay the business tax region. And the withholding tax is really subject to different treaties. I pick up two treaties that we have mentioned before. The China-Hong Kong treaty, the withholding tax rate can be reduced to 7% if you have the beneficial owner status. But if you don't have, it still applies to 10%. The China-UK treaty, the interest rate has no change. It still applies 10%. And you need to get tax clearance certificate with the local tax bureaus before you're paying the interest out from China.
And that applies both to Hong Kong and to
any country
UK.
need to get a tax clearance certificate.
Correct.
So, the beneficial owner, we have Mike and Scott has talked about before that you have to verify that the company has the substance, then you can apply for a lower tax treaty rate.
Thank you. Thank you, Gabi. So that basically, within the timescale we've done, is given you a brief overview of the treaty, its application, and where it is at the moment. We do expect there to be a lot more, once the treaty's in play, we do expect to see a lot more interpretation come out from the Chinese. The number of circulars and interpretations are yet, there will happen. And the aim here is, will I be recommending to clients to go via the UK? The answer is, it's now going to be a definite yes. And but I will look for circumstances where there may still be a need to have an intermediary holding company for China, which it may have other purposes, i.e. that it would be for in the region itself, it would be looking at Hong Kong as a place, as a regional hub, rather than just an entry point into China itself. And so from my perspective, the UK is now going to be in play. But how do you justify your existence now then?
I think I'd sum it up in one word, which is substance. You're right, Mike, the UK is in play. But the thing that you're going to have to pay most attention to is how you can take advantage of either the withholding tax reduction, which relies on substance stroke beneficial ownership, and how you can avoid the Chinese GAR applying, which again depends on the substance that you have in that holding company. That will depend on each group's individual situation, either at the time that you put the structure in place or at the time that you make a sale or you pay the dividend. Things move, things change, not only in your facts and circumstances, but also in the Chinese, the SAT's interpretation of what's going on. So my takeaway for this is keep your eye on this kind of stuff. It's moving the whole time, and don't assume just because something was the case a year ago that it will hold true now.
Thank
Thank you.
you.
The answer to the last one, yes, I'll send them to circulate to Annie. For the slides,
Yeah.
can we circulate them? And I said, yes, we'll pass them through
Sure,
to you.
we'll certainly circulate. We have one final question, maybe. I think you've touched on pretty much everything today. It's a specific enough question. Is there Chinese stamp duty on share pledge as security for a foreign loan? I say that as though like I know what it means, but I said that very confidently. I really don't know what that means. So over to the experts.
So basically the question is if we put the security of the shares for a foreign loan, will we have to account for capital duty or stamp duty in China?
And I'll have a go at answering it. I think the answer is no. I'm not a Chinese stamp duty expert, so Jack,
It's not good enough.
Yeah.
Exactly. If you wanted to follow up, Jack, I think if you got a detail and send an email.
Drop an email to us. Yeah, and I actually think it's right. I don't think the pledging or something has yet caught it into the Chinese net. So, and I'm assuming it's just pull up as a security rather than as a they're actually being transferred, or there's been a physical transfer document being required.
Okay, just as a general question, I think it always comes up in these more sort of technical and rule-based parts of business with China. The implementation across China, that's always been a little bit complicated, and whether the rules cascade down and whether there's, rules come out and then implementation rules come out 6 months later and all of that kind of stuff. In terms of consistency of implementation, how this will work, is it easier these days to navigate tax in China, or how is that? It's the $64 million question, guys.
I think we'll all have a little go at it. I see it from a UK perspective, and I have regular sessions with my Chinese colleagues, and I feel that it differs. It still differs from province to province and different tax region to different tax region. I don't think you can generalize and say it's standardized, not yet. And I think you have to be prepared for that. What you do notice in some of the key territories, Shanghai, Beijing, Shenzhen, all of the big territories, you are seeing a lot more standardized approach. So that's my perspective, which does make it complicated when I have to give a client and try and give a closed answer to them. And Gabby, you're on my calls. Do you agree with that as well?
Yes, yeah.
So Scott, I don't know how you see it from a Hong Kong perspective.
I mean, I'd agree with you that there is no uniformity of treatment, which makes it difficult. There is, yeah, I agree totally that the big prefectures, provinces, cities they understand that the consistency of treatment is important for business, and I think they are making inroads in getting there, but they're not there yet.
Okay, fair enough. I mean, I think that's the great China answer, which is progress all the time, but keep doing your business and keep being positive and keep getting out there.
And watch this space.
Yeah, absolutely. And keep abreast of updates. I think it's business in China is very much a living organism, and it changes every day. All right, well, thank you very much to Mike, to Scott, and to Gabby. I think we'll probably just wrap up there for the day. If you have any more issues, any more questions, feel free to contact any of us, and we'll be happy to pass them on to the experts, and they can get back to you. This broadcast will be posted on our YouTube channel, where you can find all of our webinars. We'll also send access to the presentation as well. You'll notice a part on our webpage, which is for webinars. Just if you drop down from what we do, you'll find a place called webinars. There you can register for upcoming sessions, and you can also have a look at any of the past webinars that we've done. So if you've got a colleague or friend who kind of should have seen this, maybe your finance guy was away at a meeting this morning, or you didn't catch it all yourself the first time round, please feel free to catch up on everything that we do. Other than that, if you have one upcoming event that I draw your attention to, which is the China Business Conference, which is CBBC's flagship event, that will take place on the 14th of January in London in the QE2 Conference Centre, where we're getting a pretty exceptional program together for that. So if you're interested, please go to our website and register for that. And finally, that's it for this morning. If you have any feedback and suggestions, be that on the topics that were raised today, or if you have a webinar that you'd like us to do or like to participate in, please feel free to contact me. So that's pretty much it for this morning. For those of you in China, good evening. Have a great Thursday evening. Everybody else, good morning, and people in between, have a great day. So thanks very much for your time. Goodbye now.
Thank you. I'll be mute now.